So, what is infinite banking? You may have heard of this term before, but maybe you never really understood the concept. Well, this is a system where one becomes their own banker by growing their own liquid cash value inside a properly designed whole life insurance policy while borrowing against it to fund major expenditures, emergencies, and outside investment opportunities. A little fun fact: entrepreneurs like J.C. Penney, Ray Kroc, and Walt Disney actually used a whole life insurance themselves as a private bank to either start, grow, or save their own businesses. So, whole life insurance is a permanent insurance versus a term policy where a term is only for a certain duration. This means that with a whole life insurance, this policy is guaranteed for a lifetime as long as the premiums are paid on time. Term insurance, like I said, only lasts a certain time frame. So you might have a 10-year, 20-year, or 30-year term policy, but you will not be able to grow any kind of cash value or equity within the policy. Now, the premiums of a whole life insurance goes to three components. You have your fees and operational costs. A portion of that premium also goes to cover the death benefit. So if you pass away, there's a certain amount of money that goes to your beneficiary or your family. And then the third component that your premium goes to is the cash value that grows tax-free within this policy. Therefore, part of the premiums is funneled into this cash value savings portion. So what are the pros and cons of this concept or the whole life insurance? Well, let's start with the cons. Cons is that it requires long-term strategy and a lot of discipline. You have to make sure that you pay your premiums on time. The monthly premiums can be quite high as well. And also, if you don't pay back the loan, that amount that you owe gets deducted from the death benefit near the end when you pass away. A few of the pros of using a whole life insurance or this infinite banking concept is you may borrow for anything you'd like without any explanations. There are no credit checks required to borrow. The dividends, loans, and withdrawals are tax-free. Cash value continues to grow and increase over the policy lifetime. Interest rates are generally lower than other traditional methods of borrowing, and you can actually pay back yourself at your own pace. Some of the policies that I put into place, we actually make it so that it's paid up in 20 years. So that basically means that you pay 20 years into this policy, and then after 20 years, you won't have to worry about putting a single dime into it. It's paid off, and you will continue to receive dividends, and your cash value will continue to grow over the course of your life. So how do you start? If you feel that having something like this is right for you, or if you're curious about it, you want to make sure that you start as young as you can, or start if you haven't, because the younger you are, the premiums are generally lower. Sometimes qualifying for this type of coverage may be more difficult for older individuals or those who have poor health. Number two, you want to choose a reputable insurer. You want to look at the company as a whole. How long have they been around? What are their dividend scales? How strong have they been? And number three, you want to make sure you find an advisor that knows how to structure this policy properly, because if it's not structured properly, you may not be able to grow that great of a cash value, nor would you be able to borrow as much as you would like. If you guys have any more questions regarding this, feel free to, message me, leave a comment, and I will do my best to help you out or answer any questions that you may have.